The American housing market's current collapse didn't appear out of nowhere. It's a result of years of built-up pressure, hidden cracks, and reckless financial decisions finally breaking open. For nearly a decade, the U.S. enjoyed one of the largest housing booms in modern history. Cheap loans, record low interest rates, and pandemic stimulus money created a false sense of security. People were convinced prices would only go up, that real estate was the safest investment. But every bubble eventually bursts, and this one is no different. The problem began when the Federal Reserve started hiking interest rates to fight inflation. What seemed like a simple policy adjustment sent shockwaves through the entire housing system. Mortgage rates doubled almost overnight, jumping from under 3% to over 7%. For the average family, that meant the same $400,000 home suddenly cost hundreds more every single month. Buyers were priced out. Sellers pulled listings. The housing market froze. But the deeper issue isn't just about rates. It's about debt and greed. For years, Wall Street investors and large corporations bought up homes in bulk, pushing out regular families and driving prices sky high. Now, with the economy slowing and credit tightening, those same investors are quietly backing out, leaving ordinary homeowners to deal with the aftermath. Meanwhile, construction companies that expanded rapidly during the boom are halting projects midway. Builders are sitting on unsold homes, unable to find buyers. Entire neighborhoods that were supposed to represent the future of American housing now sit half-finished, ghost towns in progress. And it's not just about homes. The ripple effects are spreading across the economy. Furniture stores, appliance retailers, and contractors are all reporting steep drops in demand. Local governments, which depend on property taxes, are feeling the squeeze. It's the same chain reaction that started in 2008. Only this time, the players are bigger and the stakes are higher. The cracks beneath the surface were always there, masked by years of easy money and optimism. But now, as the illusion fades, the true state of America's housing foundation is being exposed. This isn't just a correction. It's a reckoning, and it's only the beginning. Across America, homeowners are facing a painful déjà vu, the return of negative equity. For those who lived through the 2008 crash, the term still carries weight. It means owing more on your mortgage than your home is actually worth. And now, that nightmare is making a comeback. In markets like Florida, Nevada, and Texas, home values that skyrocketed during the pandemic are now dropping at alarming rates. People who bought homes in 2021 or 2022, when competition was fierce and prices were inflated, are watching their home values fall by tens or even hundreds of thousands of dollars. For some, the dream home they stretch their finances to buy is now a financial trap they can't escape. It's not just individual families feeling the sting. Entire communities are being dragged down. Real estate data shows that in several states, more than 15% of recent home buyers are already underwater. And when that happens, people stop spending, stop investing, and start panicking. If they lose their jobs or face unexpected expenses, foreclosure becomes a frighteningly real possibility. What's worse is that many of these homeowners even social media, real estate only goes up. The hype and fear of missing out created buying and ignored fundamentals like income growth and affordability. When interest rates spiked, that illusion shattered. Monthly mortgage payments jumped by 40% or more for millions of Americans, especially those with adjustable rate loans. For homeowners trapped in this situation, selling isn't an option. They have to pay the bank just to walk away. Renting out the property often doesn't cover the mortgage either, as rent prices have started cooling in many cities. That leaves people stuck, watching their home values shrink while their debt stays the same. The emotional toll is enormous. For many Americans, owning a home isn't just about investment. It's about identity, family, and stability. Losing that, or realizing it's slipping away, hits harder than any stock market dip. Experts warn this may be only the beginning. If job losses continue and the economy slows, negative equity could spread nationwide, turning isolated problems into a full-scale housing crisis. The question now is, will history repeat itself, or can the U.S. learn from its past before it's too late? When people think of the American housing market, they often imagine families buying their first homes, neighborhoods growing, and communities thriving. But behind the scenes, something much darker has been happening. Over the past decade, Wall Street firms like Blackstone Invitation Homes and other investment giants quietly bought up thousands of single-family homes, entire neighborhoods in some cases. What was once a cornerstone of the American dream became a portfolio asset for billion-dollar corporations. It all started after the 2008 financial crash. Big investors saw an opportunity when millions of homes went into foreclosure. With cash in hand, they bought those properties for pennies on the dollar, while ordinary Americans were still trying to recover. What seemed like a short-term investment strategy turned into a long-term takeover. By 2023, it was estimated that institutional investors own over 350,000 single-family homes across the country, and the number keeps rising. Their strategy is simple: buy low, rent high, and never sell. They know that supply is limited, and people will always need a place to live. By buying homes in bulk, they created artificial scarcity, pushing home prices beyond what the average worker could afford. Families trying to buy their first home found themselves competing not with neighbors, but with billion-dollar funds that could pay in cash. This shift has fundamentally changed the market. Instead of homeowners building equity and stability, we now have corporate landlords dictating prices, rent increases, and even neighborhood standards. For many families, the dream of ownership has been replaced by lifelong renting, paying every month to a faceless company that owns hundreds of homes just like theirs. And when the market shows signs of weakness, these same investors pull out fast. They sell off properties, cut maintenance, and move their money elsewhere, leaving behind deteriorating neighborhoods and plunging values. It's a cycle of profit extraction that hits Main Street hardest. Critics argue that this kind of financialization of housing turns shelter, a basic human need, into just another speculative commodity. Wall Street treats homes like stocks, flipping them for profit, while millions struggle to find affordable housing. The truth is, America's housing market isn't collapsing by accident. It's collapsing by design, one driven by greed, control, and corporate power. And unless something changes, the American dream might become a corporate-owned nightmare. For years, Americans were told that renting was the smarter choice. Less risk, more flexibility, and no maintenance headaches. But that illusion is cracking just as fast as the home buying market. The rent bubble that built up during the pandemic is finally popping, and millions of tenants are caught in the middle of it. From Florida to Nevada, rent prices exploded between 2020 and 2023. In some cities, rents jumped by over 40% in just 2 years. Investors saw massive profits. Developers built luxury apartments instead of affordable ones, and landlords took advantage of desperate renters. But what goes up too fast always comes down. And now, the fall is starting to hurt everyone involved. As inflation hit record highs and interest rates soared, renters began to hit their breaking point. Families that once managed to scrape together rent are now missing payments or moving out entirely. Vacancy rates in several major cities are quietly rising, while property owners are slashing rents or offering months of free housing just to keep units filled. In places like Miami, Phoenix, and Las Vegas, rental markets that were once on fire are now cooling rapidly. This crash isn't just bad for landlords, it's bad for local economies. When rent prices plummet, so does property value. Investors who banked on never-ending rent growth are suddenly seeing their profits vanish. Small landlords who bought extra homes during the boom can't keep up with mortgages as rental income shrinks. And tenants who signed long leases at inflated prices are now stuck overpaying for homes worth less than what they're renting for. The real tragedy, though, is how predictable this was. The rent surge wasn't caused by genuine demand. It was driven by panic, greed, and speculation. Wall Street-backed property companies bought entire apartment complexes, jacked up prices, and told the media there was a rental shortage. That narrative helped justify the bubble until people could simply no longer afford it. Now, the cycle is reversing. The rent bubble is bursting, the housing market is stumbling, and America's affordability crisis is being exposed to what it really is, a system built on exploiting the basic need for shelter. The question isn't whether the bubble will pop. It already has. The question is, how deep will the crash go before someone steps in? Buying a home, once considered the cornerstone of the American dream, is now slipping out of reach for millions. What used to be a milestone of stability has turned into a financial nightmare, and the main culprit is simple: mortgage chaos. Interest rates have skyrocketed. Banks are tightening lending standards, and the cost of borrowing money has never felt heavier. In 2020, buyers could lock in a mortgage for around 3% interest. Today, that same loan could cost you 7% or more. That difference doesn't sound huge on paper, but in reality, it's devastating. A $400,000 home that once required a $1,700 monthly payment now demands closer to $2,800. For most families, that's not just an inconvenience. It's the difference between buying a home and giving up entirely. This dramatic shift has frozen the market. Sellers are refusing to drop their prices because they don't want to lose the paper value of their homes, while buyers can't afford to step in at these rates. The result? Stalemate. Homes sit unsold, construction slows down, and mortgage applications have hit record lows not seen in decades. Even banks are feeling the squeeze, with fewer people borrowing and defaults starting to rise among those who stretch their budgets too far. The chaos is also reshaping who gets to buy property in the first place. Large investment firms, not families, are swooping in to purchase homes with cash. They don't need mortgages, and they can outbid ordinary people without breaking a sweat. What we're witnessing isn't a housing market anymore. It's a power game where the average citizen is being priced out, replaced by corporations turning homes into rental assets. And for those who already have mortgages, many are trapped. Refinancing is no longer an option because new rates are higher than what they currently pay. Millions are effectively locked into their loans, unable to move, upgrade, or sell without losing money. This isn't a temporary blip. It's a full-blown structural crisis. The dream of homeownership is fading, and the system that once helped people build wealth is now designed to keep them renting indefinitely. Unless rates fall or income skyrocket, the phrase mortgage approval will soon sound like a fantasy reserved for the rich.